Our next guest says business sentiment has collapsed in the region in the last 2 months. Shaun Rein is managing director and founder of the China Market Research Group, joins us now from the Shanghai area. Shaun, welcome. Good again to see you, my friend. Why do you say that business confidence is collapsing? What's driving that?
It's good to see you. Hi. It's good to see you. Unfortunately, business confidence has really dropped in the last 6 to 8 weeks. There are a couple of reasons why. The first is even though the CPI index was okay, when you strip out pork prices, which went up 20.4% last month, inflation was only up about 0.2% in July, which is less than June. So the D word, or deflation, is still looming over the economy. And so wealthy consumers especially, and we have to remember wealthy Chinese account for about 55–60% of overall consumption. They're quite concerned, and they're concerned for 2 reasons, Ty. The first is the Chinese government doesn't seem likely to launch a bazooka-like stimulus anytime soon. Xi Jinping and the Communist Party seem okay with slow 4–5% growth, and they're not going to launch a stimulus anytime soon, which was announced during the 3rd plenum, which is the big event every 5 years where the Chinese government talks about what are the next 5 years' goals for economics. Now, the announcements that came out of there had a lot of platitudes, but we're really short on details. And that's why, again, that wealthy Chinese consumer is really concerned about spending. They're not buying, so you should be cautious about buying Burberry or Louis Vuitton or Porsche or any big ticket items, and especially real estate. The real estate sector is the biggest issue, Ty, that everybody in China is worried about. Prices are stable or dropping only 1–2%, but the problem is volumes are anemic. So if you want to sell a house, you really have to discount 20–30%. I'll give an example. One of my neighbors in Shanghai, he was trying to sell his house for $50 million last year. It didn't sell. He's cut the price down to $25 million and it still hasn't sold. So that's why investors should be cautious.
So let me dig in a little bit on what you said a moment ago, and that is that there is no indication or inclination on the part of the Chinese leadership to use the bazooka in the form of economic stimulus at this point. Is that because the leadership sees no need to do that? In other words, they don't think that the situation calls for it? Or is it because they are assuming a somewhat more defensive stance against the possibility of more confrontation with the West?
That's a great question, Ty. I think first, China's run out of money. So you got to think during the zero COVID era, there's very little business going on, so there was no tax revenue. So the first thing is the Chinese government has run out of money. They don't want to go into debt like the United States has, because at some point, I don't know when, but the United States is going to have a financial crisis because you can't double debt in 5 years like the U.S. has done. So China doesn't want to do that. But to your point, and I think it's a great point, Ty, where you're saying that the Chinese government is concerned about greater confrontation between the United States. I believe that China is holding a lot of its reserves, the limited reserves that it has, as dry gunpowder in case there's a proxy war over Taiwan, a proxy war over the South China Sea, or if the United States keeps launching never-ending sanctions on China like it has over the last year. You've seen the House and Congress is trying to ban TikTok. The Biden regime has increased tariffs on Chinese NEVs to 100%. Just today, the Biden regime put 5 more Chinese companies on the sanctions list for supposedly using slave labor. So I think China is very concerned that it might become like a Ukraine-Russia situation. So it's holding all of its reserves in case there's a bigger issue. Now, one thing for investors they should know about is that means China is stockpiling things. They're stockpiling chrome ore. They're stockpiling iron ore, agricultural products, just in case the situation and the tension deteriorates even more.
And while we ponder the unpleasant sort of implications of that, Shaun, the biggest question I got after we did a China segment last hour was from investors asking about India. It's almost as if they've just moved on. They've given it up. They don't care anymore, and they're looking for better opportunities, and they think India offers that.
So basically, I just spent a month in the United States, and I met with about 70 hedge funds and mutual funds there, and the vast majority of them are very negative on China. They're reallocating their resources to India and to Japan. So India is the next big growth engine. Now, but let's take a second and a step back, Kelly. India's per capita GDP is only a fifth that of China's.
Exactly.
So if you're an investor in the short term, yeah, India is probably better than China. But if you're a multinational, if you're a Nike, if you're an Adidas, if you're a Louis Vuitton, China is the next China. You're going to be investing in China. But for investors, you should be looking certainly more at Japan in the next month or two period.
All right, Shaun, we'll leave it there. Thanks for joining us today. We appreciate it.